I'm Caroline Hyde in New York, in for Emily Chang. This is Bloomberg Technology. Coming up in the next hour, loosening the leash on Huawei. President Trump announcing plans to relax the ban on U.S. companies doing business with the Chinese tech giant. Plus, the power of Google and Amazon, why the majority of tech IPOs in the last 18 months list the two FANG giants as a competitor or risk to their business, and what that means for the tech landscape going forward. And Bitcoin's epic rally this year is, well, starting to waver again. The price of the cryptocurrency is down double digits since Friday, what it means for the digital assets future. But first to our top story. In a victory for Beijing, President Trump said he would hold off on any additional Chinese tariffs for now and would relax his administration's ban on Huawei. But constraints on Huawei's business remain, and some analysts said, look, the optimism is overdone, with many still trying to figure out, well, what form the relief will actually take. Huawei remains squarely on the U.S. Commerce Department's so-called entity list, usually reserved for rogue regimes and their associated companies. U.S. lawmakers from both parties have also reiterated pleas to not let up on Huawei. On Sunday, White House National Economic Council Director Larry Kudlow, he commented on the move.
This is not a general amnesty. They will remain on the so-called entity list, and the national security concerns will remain paramount.
With more, we're joined by Bloomberg's Sarah McGregor in Los Angeles and Bloomberg Technology's Peter Elstrom in San Francisco. Sarah, I want to get out to you first. Talk to us about really the details surrounding Huawei, or the lack of details thereof. I mean, was it in any way expected? Because it took the market by surprise.
Absolutely. There were a lot of questions before the meeting whether Huawei would even come up in the discussions. Trump had, of course, alluded to weeks ago that he could go easier on Huawei as part of a trade deal. Of course, Trump and Xi didn't come up with a trade deal. They just agreed to keep talking. And those big issues that caused talks to break down in May originally, none of those have been resolved. And so I think a lot of lawmakers have come out, and said, look, you've lost some leverage. You've said you're going to go easier now on this giant company, this huge thorn in the side of China. And for what? If it is a national security concern as well, should we be giving that up? So I think, as you said, we haven't got a lot of details yet. We do know that the Trump administration doesn't plan to remove Huawei from the blacklist, but we don't know how it will decide on which basis, what products the company can buy from U.S. companies and what they can't.
Nevertheless, despite the murkiness, Peter, we saw chip stocks soar in Monday trading. We saw euphoria across the board. Why? I mean, what are you expecting to be eased for Huawei and the U.S. businesses working with it?
It's a good question why they moved up so much on this news. I mean, Trump could have said literally the exact opposite, and the facts on the ground would have remained the same. If he said, no, we're not going to loosen up on Huawei, but we're going to continue to offer some of these licenses as exceptions to the blacklist, it would have been sort of the opposite interpretation. But in fact, he came out and he talked about going easy on Huawei. I think Kudlow's comments are the closest that we've gotten so far to really understanding exactly what they're talking about. It sounds like the Commerce Department is planning on keeping Huawei on the entities list, and they are going to offer these licenses for some companies to resume sales to Huawei, but it's not clear which companies. It's probably going to take a while to be able to sort that out. At this point, the criteria are not very clear. Trump alluded to the fact that companies where there's no national security risk will be able to sell their components to Huawei. But what are those companies at this point? Everybody's trying to figure this out.
Sarah, everyone's left, question marks aplenty. What are we certain of in terms of a more positive mood music coming between the relationships of US and China, or even we that certain on that? Everything could be undone with a tweet, of course.
Absolutely. I think, the markets and all the observers got what they wanted out of this meeting was a promise from Trump, at least for the moment, not to escalate tariffs on China on this additional $300 billion of goods while they keep talking. But a huge gulf remains. The leaders didn't get past the big issues, whether it's IP theft or state subsidies. And those are the issues that caused the talks to break down in May. So there's been no real change. There's no timetable. There's no idea of what the talks could look like to get the parties past these breaking points. And so, I think it's a temporary sigh of relief, but as you said, on the horizon, is Trump going to tweet in a couple days and say, something has angered him over China and now he's moving forward with the $300 billion? There's just no certainty about what the markers are along the way.
There was an interesting piece put out by Tim Culpen, Peter, writing that really, overall, the Trump's Huawei deal ends one war but starts another. How does this fact that we're seeing these huge tech companies, whether it be initially ZTE, now Huawei, becoming these political pawns embroiled in such trade negotiations, what does it mean for the two technology ways and means building up in the US and China from ever coalescing, or are we starting to see a Cold War becoming ever more penetrable?
I think from the China side, even if there is this kind of temporary relief for Huawei, the facts remain the same, that they are dependent on American components in some key areas, semiconductors, optical components, a few others. And they know that over the long term, the only way that they're going to be able to escape that kind of vice is to develop those industries themselves. So China has talked about this originally quite publicly in their China 2025 plan, where they planned on developing these key technologies in a number of different areas, including AI and robotics and semiconductors. And there's no question that this episode, coming right after ZTE and a couple more like it, is only going to encourage the Chinese government and Chinese industry to accelerate their push to try to develop some of these key technologies that they need to be able to have independence from the U.S.
And Sarah, remind us of the lobbying that is probably going on behalf of the key U.S. companies that are so affected by this. It's interesting that actually on Friday we were talking about the news that Apple is making more of its products, the Mac Pro in particular, in China. There are some huge juggernauts in the US that are so exposed to China in terms of the supply chain and indeed feeding into companies there.
Absolutely. I think it was very telling last week, too. We saw a company like Micron saying, they had found some loopholes in this entities list, so they were able to still send a subset of products to China, resume those shipments after Huawei was initially put on the ban. And so I think through it, you see, companies are constantly looking for ways to get around the tariffs and now these export restrictions as well. And, they're going to find sort of any way into the market that they can, because that's where the business is and they want to remain competitive. And so definitely, I'm sure some of that message is getting through to the Trump administration as well, that, it was American companies, their exports, that were going to be hit by this. And that's not great for the manufacturing revival that the Trump administration wants to lead. And, they have a lot of power and sway in Washington. So, I don't have a lot of details on what exact lobbying took place, but you can be sure that it was going on because it was very high stakes.
And meanwhile, Peter, do you think the integration between the US companies that you're currently meeting on this business trip and indeed the Asian companies that you know so well and where usually you helm from, do you think those interlinks are going to be crumbling in the longer term? Are we seeing new ways and means of supply chains being built in the US?
I think what companies want is reliability. So if they think that the supply chain that has run through China and has served them so well over so many years is going to become unreliable because they need to pay tariffs if they ship out of China into the U.S., or there's going to be some sort of blacklisting, they're going to look for alternatives. We're going to see companies from Apple to all the other technology companies out there figure out alternative ways to be able to supply these products. And it's interesting to see the position these companies are in, because they're caught between the Chinese government and the U.S. government at this point. And when you mentioned the Apple news about relocating some production back to Apple, that is also a signal to the Chinese government that we are planning on continuing to produce products in that market, signaling some sort of dependence on the market that is very real for Apple.
Great context there. We thank you so much, Peter Elstrom from Bloomberg Technology, and of course, Bloomberg's Sarah McGregor in LA. And in regard to this trade truce between the US and China, or so-called trade truce, well, Apple jumped the most in 3 weeks. And interestingly, Wedbush's Dan Ives predicts that the company's shares could rise up to $25 or more in the coming months on a resolution to the tariff dispute. He said that the truce removes the albatross around CEO Tim Cook's neck. President Trump said he would hold off imposing additional tariffs against China, while talks resume on a trade deal. Now, coming up, it's July 1st, which means half of the year is already in the bag, and we've seen 22 tech companies hit the public market. Will the momentum continue? We discuss. And if you like Bloomberg News, check us out on the radio, why don't you? You can listen on the Bloomberg app, Bloomberg.com, and in the US on Sirius XM. This is Bloomberg. 2019, well, it's been quite the year for tech IPOs, with big names like Lyft, Uber, Pinterest, you know them, all going public. But there is a significant shadow, or two to be precise, hanging over these newly traded companies. Both Google and Amazon have a rather significant hold on a number of these tech companies that have hit the public market. Joining us to discuss in San Francisco is Mark Mahaney of RBC Capital. Also with us in Bloomberg Technology's Garrett DeVink, with me in New York, who wrote the story. And for many, I'm sure they're aware of the power that these two companies have and the dominant force that they are. But spell it out for us, exactly your story perhaps tells Lyft the example best about just how much they depend and indeed are sort of controlled by these companies.
Right, so I mean, Lyft, for example, spent $90 million on Google Ads in a single year last year. Those people went to an Apple app store, downloaded the Lyft app when they opened it. Google Maps was powering the maps behind it, something else that Lyft had to pay Google for. All of this was hosted on Amazon servers using Amazon Web Services. Lyft has a $300 million contract with them through the next 3 years to pay for all that. And on top of it, Google owns 5% of Lyft and has a board seat itself. So, all it's obvious that Google, Amazon are very, deep within the digital economy. But when you look through these filings, you really see how concretely they are kind of, the infrastructure behind how many of these companies work.
And in some ways, this is a blessing. In some ways, it's a curse. I mean, Mark, you focus on both Amazon and Google. And from the blessing side of the equation, do you see it as a good element that these companies have, well, so much riding on, whether it be financially, but also from their future revenue stream from these recent IPOs?
I don't know, Caroline, there's good and bad to that. The benefits of cloud computing is that it allows startup companies that eventually want to go public or are going public, to avoid a lot of infrastructure costs. You can treat all of your IT needs as variable costs rather than big fixed costs. You don't need to buy and build up a very large IT department to scale up a business. That's been the magic behind AWS, Amazon's Web Services, also behind Microsoft Azure and Google Cloud. So in many ways, what they're offering is a real benefit to these companies. But there's no doubt that in order to scale up on the internet, you're probably going to need to pay one of those three cloud providers. And then if you're a consumer-oriented service and you need to get consumers to use your service, to use your app, to get to know you, you're probably going to be spending money with Google, Facebook, and probably just those two. Like, that's how you get brand awareness on the internet these days. So I don't know if they're toll keepers. That's probably too strong of a word. But they're clearly the biggest channels out there, and you are going to be dependent on them. Hopefully, companies that are really successful and that investors like to look at are companies like an Uber and a Lyft long-term that can create brands that are strong enough that they can avoid having to get traffic only through those paid channels.
Yeah. Garrett, your piece also shows how many of these IPOs, I think it's 17 out of the recent 22, right, that are in some way mentioning Google or Amazon in their statements. Is this something regulators are looking at? Are they actually worried that perhaps if they clamp down too hard or try and push for breakups and the like that Elizabeth Warren's talking about, this could actually impact those that sit downstream?
Right. Yeah, I mean, on the one hand, you could say, look how powerful these companies are. We surely need to break them up. On the other hand, you could say, well, they're not interested in necessarily disrupting these smaller companies because they're their customers. They want them to keep growing. Google wants Lyft to keep growing and still use Google Maps and pay more and more for it every year. So, you can kind of look at it from both directions. And as this argument goes forward, I'm sure you'll be seeing the arguments from both sides. But I just want to say, I don't necessarily think that by breaking up these companies, you would necessarily disrupt that web, in a really deep way. I mean, you could still buy Google Maps from, Google Maps Limited and buy Google Cloud Services from Google Cloud Services Limited. So, we'll see how it plays out, but I'm sure this will be a topic of conversation when it comes to antitrust.
Before we go into the antitrust equation for the behemoths, Mark, I want to talk about the fact that you cover Lyft, you cover Pinterest as well. When you saw that in their filings they do show this competitive exposure and general exposure in terms of supply side needs from Amazon and Google, did you see that as much of a risk factor? Does that worry you? Would you like them to invest in their own independent service, for example?
I think the answer to that question is no. I didn't see it as a risk factor. I hadn't really thought about the way you set up the question. So if they didn't lead, if they were going to have a cloud services provider, it was going to be one of three names. It was either going to be AWS, Azure, or Google Cloud. And chances are it was going to be AWS. That's usually the lead cloud provider. They have almost 50% market share. So if they didn't do that, then the P&L that they would have gone public with, that they'd be going public with, would look a lot different. And you'd have a lot more CapEx spending. So it probably would be, frankly, a less attractive business model. And you'd also raise the question of why are you trying to vertically integrate and build out all that infrastructure and manage all those data centers and those server stacks and IT departments when there are three companies that are doing a phenomenal job of allowing you to outsource it. So I'll just twist that question back at you, Caroline. It's a great question. I hadn't thought about it before, but no, I don't see that as a I don't see that as a competitive issue. I don't think that's a dependence risk. And there is the option, by the way, of switching. And we have seen companies. Snapchat went public and switched or started switching over, migrating over from Google to Amazon. So as long as you can migrate, I don't think there's risk.
And Mark, what about the risk from a competitive perspective, from the regulatory viewpoint that we're starting to see coming from Capitol Hill upon Amazon, upon Google? Do you think that there is a risk that they are seemingly so intertwined with the rest of the tech ecosystem?
Possibly. I just look on regulatory risk. It's something that's clearly become a major investor issue across technology. We actually just hosted a call earlier today with an antitrust expert to talk about the risk that these large platforms face, particularly Google, but also Apple, Amazon, and Facebook. I think the chances of these companies having to be forced to divest assets, I think that's actually extremely unlikely. I generally think that if you company says they hold assets for multiple years, I think government regulators would be very loath to try to unwind any of that. I think it'd also be very hard to do that. I think you're more looking at fines or changes, modest at the margin changes in business practices. I would make one quick comment. We just listened to a weekend of presidential Democratic debates, and big tech really didn't come up at all, except for the one time it did was in concerns over whether Amazon is paying its fair share of taxes. The issue of Google's strong market position or Facebook's or anybody else's actually didn't come up, and that's probably the best political barometer. If it doesn't come up in a presidential debate, it means it probably doesn't matter.
Yeah, they certainly did see the share prices rally on the back of that Wednesday night debate between certainly Cory Booker and the likes of Elizabeth Warren discussing it. We thank you, Mark Mahaney. I'm pleased to say from RBC is going to be sticking with us. Garrett DeVink from Bloomberg Technology is a great story, and we urge you to go read it. Now coming up, snapping back, how Snapchat is managing to lure in more users. Can it keep fueling its meteoric rise in terms of share prices here? This is Bloomberg. Now, shares of Snap gained slightly on Monday, but for the year, Snap has risen more than 150%, sharply outperforming its peers. And MoffettNathanson has been calling today this a, quote, Cinderella story, thanks to a forecast surge of more than 15 million users since March. To tell us more about Snap's turnaround, still with us, RBC Capital's Mark Mahaney, who currently has an outperform rating on the Snap stock. Mark, it's interesting how much shareholders have got behind this particular company. Do you think the 15 million user additions is a realistic one going into its second quarter earnings?
15 million in one quarter? No, it doesn't sound realistic to me. But look, we upgraded this stock earlier this year. We have a $17 price target. We think this is an asset that's at an inflection point, and it's for fundamental reasons, which is they've done a lot of innovations around bringing in games, improving the user interface, but most importantly, they fixed their app. It wasn't working well on Android phones, which are the dominant phone operating system worldwide. So if your app doesn't work on Android, you've got problems. And I think they finally fixed that. I think that can lead. We had users decline year over year in the most recent quarter, but we think we can start seeing inflection up. We think we can have a couple of quarters of possible revenue growth acceleration. If gross margins continue to expand, operating losses continue to decline, we think the stock can go higher. There's also the backdrop here. I know the stock's up 150% on the year, but that's also in part because it was demolished last year, and this stock was at a all-time low last year. So that created kind of an easier setup just for full balance there. Yeah,
it's good to get the context in that respect. Mark, your perspective, though, of the competitive landscape out there, because everyone had sort of put squarely some of the concerns about Snap coming from, of course, Instagram and the fact that stories were doing so well over in Instagram itself, and people perhaps didn't need to go to Snapchat in the same way. Is Facebook still the competitive force it was in that respect?
Oh, I think so, Caroline. I don't think that's changed. Facebook with Instagram, TikTok out of Asia. I think there are a couple of different services. The one thing, just from a user perspective, and I sometimes think investors don't quite see this because they may be age demoed out of the core Snapchat audience. I've heard is that the core functionality, I think, at Snapchat for most of its users is as a communications tool. It's those ephemeral messages, and you can. They're not. It's not text. It's visual messaging back and forth in a very user intuitive way. At least for the younger demographics, the 13 to 34-year-olds. So I think if that's the case, then Instagram is more of an entertainment channel, not a communications channel. TikTok is much more of an entertainment channel rather than a communications channel. So in that case, its core vision, its core mission, I guess, for Snapchat is probably competitively insulated. The question is whether it can really expand into being a lot more than it is. I don't know about that. I don't think the company knows either. But in terms of the near-term improvement of fundamentals, I think that's going to occur, and I think that allows the stock to at least continue to outperform for the rest of the year. What it's like in 3 to 5 years, I don't know.
I like that nuance there, Mark. And looking at another outperformer, well, Facebook is, of course, a company that you look at, and you've got an outperform rating, $250 price target. Yeah. This is a company that has been beset by issues in terms of regulatory scrutiny, but also having to rein in some of the fake content that it finds online, hurtful content, hate speech. How much are you finding the moves being made impressing you at the moment? Just today we had yet another headline on how they're going to be ensuring they're on top of the census data that's due in 2020.
I think Facebook's been this is a case where public sentiment got dramatically too negative on this stock, and the advertiser sentiment, which is where the money comes from, didn't really change at all. If you look at the year-over-year growth in ad revenue, it's been very consistent. It's been decelerating, law of large numbers, but it went from 38% to 35 to 33 to 31. That's very modest deceleration, especially given the base, the size of this company. And now, wait a minute, we find out that there's more inventory that can be monetized. That's the Explore tab within Instagram. And it looks like Instagram stories and Facebook stories are starting to monetize well. And now we've got this potential cryptocurrency. I really don't think that's the Libra play. I think it's more like a super app play. So there's more to Facebook than we thought. And it's gone through this massive amount of controversy over the last 12 months. And it didn't really impact the growth rate. It tells you that the value proposition of Facebook to advertisers and to consumers is super high. And this is one of the cheapest stocks you can find in tech, especially relative to its growth. That's why we like the stock. That's why we like Facebook here.
Mark Mahaney with 22 buy recommendations, 7 holds, not a single sell. We thank you very much, coming from RBC. Now, coming up, delivery time. Can Tesla bounce back from a lackluster first quarter? We preview what to expect from the electric car maker's latest numbers. That's next. Plus, the chip-making industry is consolidating rapidly. We'll be discussing M&A. This is Bloomberg. This is Bloomberg Technology. I'm Caroline Hyde in New York, in for Emily Chang. Now, it was just 2 quarters ago that Tesla deliveries hit an all-time high. In the fourth quarter of last year, the electric vehicle maker delivered more than 900,000 vehicles. In the next quarter, not so sweet, as that number fell to around 63,000. And now we're awaiting the numbers for what Tesla hopes will be a bounce back 3 months. Analysts are expecting Tesla to report that it delivered about 88,000 vehicles in the second quarter. So will Tesla be able to make good on its expectation, delivering up to a whole 400,000 cars in 2019? You got an eye on all those numbers? To discuss, let's bring in Bloomberg's Dana Hull, who covers Tesla for us in San Francisco. And the 88,000 is not quite enough to reach the so-called record quarter that Elon Musk certainly has been bragging about.
So the all-time record was 90,700 in the fourth quarter, and Elon Musk, in an email to employees, urged them last week to go all out and break the record. And I think it really comes down to how they did over the weekend. A lot of analysts put out their note before the weekend. We know that there was a lot of activity over the weekend and a lot of deliveries. So they could have made it. We just are waiting to find out if they did, and if they beat the record, by how much.
And what's really interesting, you've got a great story out today, sort of showing how Tesla's double-edged sword in terms of deliveries. Because even if they make this stellar number in terms of the number, particularly Model 3s that they're pushing out, some of the buyers mean that maybe it's not quite as lucrative as you'd hope.
Yeah, so I mean, the number of deliveries is super important, and obviously if Tesla can show that they rebounded from a kind of dismal first quarter and broke an all-time record, that would do a lot to allay the demand concerns. But the big question that investors have is margin and mix. And so if they sold a lot of lower-end Model 3s, that's going to impact gross margins. And, you know, there is some concern that the Model 3 is cannibalizing the Model S, which has always been the kind of more expensive car. I talked to one owner who was waiting for the Model S refresh, decided to get a Model 3 instead. So it'll be really interesting to see in this delivery report, you know, what percentage of the cars delivered were 3s versus the X and the X. And that's all going to impact quarterly earnings.
Quarterly earnings, and it's all going to impact the share price, which, I mean, even despite the 21% rally that we've seen since June, is still down about a third on the year. Is it really cannibalization and indeed the lack of demand really that has hurt shareholders and indeed analysts' views on this company so hard?
Well, I think people want to know, is Tesla still a growth story? I mean, this is a company that has largely grown quarter over quarter, although the first quarter was really bad. So, you know, is it going to be unparalleled growth, or is there kind of a ceiling to that growth? And that's what people want to know. I mean, this is the first time that Tesla is delivering cars, you know, not just in the United States and North America, but to China and to Europe. So they've got this enormous logistics issue that they've been trying to unravel. And, you know, we're just trying to figure out, you know, it's like, on the one hand, is there a ceiling to demand? On the other hand, as more people get the cars, they tell their friends about the car. So just any kind of visibility into what the growth trajectory looks like. Another key metric will be as if Tesla reaffirms its guidance for the full year.
All eyes on that number, whether it's the 400,000. Dana, I'm interested in how it is on the inside of Tesla right now. Pretty exhausting, I'm sure, after the weekend that was. And we know that Elon Musk, you know, sleeps on site sometimes when really he needs to get the pedal to the metal. But we have heard of yet more executives leaving, potentially this time head of production over at one of the Fremont production areas. What's stability like internally?
There haven't been any big I mean, yeah, Peter Hochholdinger, the VP of production who came from Audi, did leave Tesla last week. Today it was announced actually that he's gone to Lucid, which is the electric vehicle startup that took some money from the Saudi PIF. So we know where he's landed. There haven't really been any huge executive departures of late, but at the same time, there haven't really been any big high-level hires. So it's kind of like you're seeing a lot of promotions from within, but not a lot of big names joining. You know, the departures at this point are kind of old hat. I don't think the market reacts to them that much.
Yeah, I've got a little bit numb on that front. Well, we'll see how numb or effusive they are indeed about the numbers that are set to drop very soon in terms of the actual production. Dana Hull, thank you for taking us through them all. Now, the Boston Pops Fireworks Spectacular is the country's largest and oldest public 4th of July event. And here's a taste of what to expect. Do not miss the Boston Pops fireworks. Spectacular. It's live July 4th at 8 p.m. Eastern time right here on Bloomberg Television. Now coming up right here, right now, Bitcoin tumbling yet again, undoing some of this year's epic rally. Is the bubble about to burst? What do the technicals tell us? We'll discuss all things crypto next. This is Bloomberg. Applied Materials has agreed to buy Kokusai Electric from global investment firm KKR for $2.2 billion. Now, like Applied Materials, Kokusai produces semiconductor manufacturing equipment for major customers including Samsung, Intel and Taiwan Semiconductor. And the Japanese company will operate as a business unit of Applied Semiconductor Product Group and continue to be based in Tokyo. Joining us to discuss is Bloomberg's Ian King. And the consolidation wave continues. Why is Applied Materials going after this Asian competitor to a certain extent?
Yeah, I mean, there's a technical reason for it. They are they do something called batch processing, which is you processing the wafers that become chips in batches rather than individually. This opens up a new area of the market for Applied Materials. Will help them to better penetrate memory chip makers, companies like Samsung, companies like Hynix, companies like Micron, according to the analysis that's been written. But basically, it's a get bigger exercise, Caroline. I mean, as you pointed out, their customers are getting bigger, the costs are getting bigger, so you really need the scale in order to keep up with that trend.
Got to keep on getting bigger. What about the regulatory implications of this? There's going to be scrutiny, lots of regulators looking at it. Do you think they have any food for thought?
Yeah, no, that's an excellent question. We've already seen Applied Materials get knocked back. Do you remember it tried to buy Tokyo Electron a few years ago and got stopped doing that? They have said this morning, look, we don't see this as being something that US regulators would necessarily look at because there isn't really an overlap. But as we know, if you're doing business in the world of chips, you're going through China, you need approval there perhaps. So that I think is giving some people some pause, but at least initially they said this morning that there's nothing to worry about.
Yeah, you bring up China and it's an interesting one given that we've just come out of the G20 and a stay of execution to a certain extent when it comes to trade tariffs. But is this sort of global M&A play going to be in any way within the trade tariff headwinds?
Yeah, I mean it was assumed up until about 6 months ago that with this increasing ratcheting up of tensions that it would just become another tool that regulators in the US, China, wherever would use to basically cause each other problems. But what we've actually seen, relatively recently is the re-emergence of deals of one or two relatively small kind of tuck-in deals, the bankers like to call them, happening here and there. So the market doesn't appear to be totally frozen, but it would probably only take one more refusal, one more deal to get drawn out and killed to sort of refreeze things in that respect.
Interesting, and maybe refreezing after what has been a pretty active sphere within chip making and deal making. You referenced it, the consolidation. Remind us, what are the sort of general headwinds at play here? Why everyone's scaling to such an extent?
Yeah, I mean, it's, there are a couple of things at play. If you are in the business of actually making chips, it's getting more and more expensive and it's getting more and more difficult. Basically, the amount of revenue you have to justify putting one of these $6 or $7 billion plants in the ground is just going up and up. It's enormous. I mean, think about it. You're investing $6-7 billion to build a state-of-the-art plant. In 5 years' time, it's out of date. It's on its way to being useless. So you really need to get a rapid return on your investment. If you're providing equipment for one of those plants, literally hundreds of millions of dollars it takes to develop that equipment that's then made obsolete. Really, again, you have to be selling at scale, and there are just fewer and fewer companies that can do that, and the ones that are capable of doing it are getting bigger.
Putting it into a global perspective for us. Ian King, we thank you. Now, let's shift gears a little bit. And after last week's roller coaster crypto ride, Bitcoin, well, it's been slumping again. The world's largest cryptocurrency fell at one point more than 18% on Monday from Friday's close to almost $10,000. This after a week of extreme price swings, where at one point it reached almost $14,000. Bitcoin is still up almost 200%, though, remember, since the start of the year. But just how much more volatility will we see? Joining us to discuss is Bloomberg's Mike McGlone, our Bitcoin know-it-all here at Bloomberg. And I mean, amazing swings that we're seeing, and amazing swings that we see over the course of the weekend.
Yeah, it's been moving up a lot on the weekends, and finally, there's people I think overweighted for that, and it went down last weekend, about $1,000 and $2,000 today. But to me, the key thing about Bitcoin is I was looking up at $10,000 resistance as a significant level 2 months ago, and here now we're kind of looking down at $10,000 as support. So overall, the trend's higher. But you mentioned volatility. As its migration towards digital gold, you really want to see that volatility decline a little bit. So some back and fill should be expected, some range trading should be expected, but the trend's up.
Trends up. What about what is, remind us, fueled the buying up to 14,000? I know you're a man who likes a chart and likes the technicals rather than the fundamentals, if there are any when it comes to crypto. But many talked up Libra and Facebook. Many talk up institutional use or indeed getting into that game. Do you think that's what the moon music has been good?
All the above. Now, that's the thing about cryptos. To me, in markets, I really like to watch fundamentals too, but in cryptos, technicals really drive a lot. I mean, they're very highly speculative, so we're seeing a lot of that. But Libra was a key statement that really favors Bitcoin. It just points out, if you look forward into payments, it's going digital. And Bitcoin is a unique case. It's like gold. There's only one gold in the world of 118 elements. There's only one Bitcoin in the world of almost 3,000 cryptos. So that's really positive. And then we had record shorts just a few months ago. And the key thing also is an increasing number of countries with negative interest rates, the Fed easing, the potential for sun money. So I think it's significant. Today was the worst day of the year for Bitcoin and for gold, which shows that they're getting closer together as companions. And overall, the bias for me for the rest of the year is still higher.
So do you really think that the people buying Bitcoin are doing it as a diversification in some way? You think that actually institutions, hedge funds, money managers are coming in and buying into it as some sort of haven rather than it be the cypherpunks and those that are interested in dabbling on these things on the side?
To me, that's part of the key migration we're seeing this year. And evidence of institutions coming in is just look at futures open interest. It's doubled in over a year. It's all-time record highs. Now, it's only been around for a little less than 2 years, but that's institutions coming in. They're not just going for this, all these other cryptos. They're going for digital gold. And the common theme I'm hearing is 1% of your portfolio. Be willing to lose it, but you could do very well. And it's a very good diversifier. And I think it's a very good companion in this case with people who might be interested in gold. And by the way, gold, ETF flows are still very positive.
Gold bugs versus crypto bugs. The huge animosity on Twitter is quite something to behold. But what are you expecting? You've got a big research note coming out to sort of spell out what we should expect for the second half of the year. It's impossible with the volatility at such levels, but how will the evolution continue, do you think?
Well, the key thing I'm putting right now is that I have a very wide range. 6,500 is very good support, and 20,000 is very good resistance. I think we're going to get towards 20,000, but expect the volatility and don't be too fearful if we get down to 6,500. But overall, that evolution should continue. What I'm worried about is we see continued focus on modern monetary theory and Fed easing and negative interest rates. That's only good for Bitcoin and gold. And it's just a question of how much they migrate and how they do it. But to me, it's just a matter of time for both these assets to go higher, unless we have something different that switches the trend from the first half, which I think is very unlikely.
And globally speaking, there's always, we know, a lot of demand had been from China. There's been regulatory effects there. But where do you see a lot of the trading happening at the moment? Where do you see a lot of the buyers stemming from?
Well, for me, since I was in Hong Kong this time last year, I got a sense for the really desire to do something about capital controls. And the minute I saw protests on the street in Hong Kong, you see more of that. That's a bid for Bitcoin. That's a bid for people who are interested in diversifying their lack of ability to diversify their capital or their currency. So to me, that's still bullish. Where that's going in remittances and global currency, it's only positive. It's just a question how it's done and properly. And the best thing, I think, for Bitcoin to continue to migrate is lower volatility. Because right now it's very speculative, we get that, but it's really part of the migration towards digital gold.
When do you think the low volatility will kick in?
I was hoping it'd be sooner this year because when it kicked in, really, it rallied so fast. It was like, oh, volatility is way too high. Because the last time it bottomed, volatility made a new low. So at the moment, I would hope it migrates and does some back and fill and does a time correction, as we like to say in technicals, for a good long time. The more time corrects, the better, the stronger the base it starts to form for higher prices.
Mike McClone, we always love having your analysis. We thank you. Now, still ahead, Apple has lost multiple design team members this year. Now, one key designer is helping create robotic apartments. How Bumblebee Spaces is bringing AI to interior design. That's next. This is Bloomberg. Last week, key Apple designer Johnny Ive announced he is leaving the company to form his own. But he isn't the only designer jumping ship. In April, Apple industrial design team member, that's Rico Zuckendorfer, left the company to join Bumblebee Spaces, a startup seeking to merge robotics with home furnishings. It has developed beds, closets, storage containers equipped with robotic systems that allow the furnishing to be raised into ceilings, increasing floor space. Zuckendorfer worked on numerous Apple devices, including the Apple Watch, during his 15 years at the company. I'm pleased to say joining us now is his new boss, Bumblebee Spaces CEO and co-founder, Sankashan Murthy. Thank you very much indeed for joining us, Sankashan. And talk to us, first of all, what Rico is going to be adding to your portfolio in terms of design.
Yeah, definitely. Yeah, instead of my new boss, like I'm his new intern. We're here to learn from him and get kind of his advice and wealth of knowledge that he brings from decades, like close to 20 years of being in design and 15 plus years at Apple, shipping some of the best products in the world. Just the attention to detail in every aspect of design. Design doesn't just mean look and feel of what Bumblebee will be. It will be how the product will work. So we're really excited to have Rico join Bumblebee, and this will be a new frontier for us. We say we leveled up. We basically got a chance to give Bumblebee the best shot at it in the world.
Sankashan, talk to me about putting your clothing in the ceiling. Like, can you paint the picture of how this actually all works, how you fit within certain spaces? Because it's slowly coming to the market. You're already working with certain real estate developers and the like, but what's becoming a reality?
Right. So just to give you an overview, traditionally houses have been built in 2 dimensions. So every time you need a function to your home, you add it on your floor. And it's basically everything's optimized on floor plan. You think about anytime you think about the home, it's measured in square feet, right? So 600 square foot home, and you get a living room, a bedroom, a closet, a kitchen, and a dining table. Everything's spreading out in 2 dimensions. And we're never using all of the functions all the time. And in fact, we waste a lot of space. As population is growing, as more housing needs are growing in the planet, we're constrained for space. Space is the one finite resource that we cannot just get without at the cost of, we're basically getting it at the cost of the surface area of the planet. So what we look at is essentially, can we open up a 3rd dimension? Can we only bring the function to you 100% when you need it and 0% when you don't need it? So if you need a bedroom, it's a great bedroom. It's an amazing, beautiful bedroom, but you don't need it all the time. When you're up and about, when you're working out, you don't need the bedroom sitting there. Or same with closet, like you go there to pick up your t-shirt, rest of the time you're paying for it, and heating, cooling, mortgage, taxes, so many resources consumed to build out in 2 dimensions. So we take over the ceiling plane, and all our modules, all our furniture kind of stays in the ceiling. We bring it down when you need it and make it disappear when you don't.
How does the artificial intelligence fit in here? Because I was reading that perhaps you can find out where that long-lost tennis racket is in the back of your cupboard. Right. But how does that work?
Yeah, so I mean, if you think about how houses are, on a very first principles level, houses are piles of stuff that you've arranged in different places, right? You have bookshelves and closets and cabinets, and there's a lot of storage. And the more space you have, the more storage you end up having. Like we're realizing that people don't, when you own things, there's a lot of stuff that you don't even use. So, and your home is, like when you inventory the home, you suddenly become aware of what all you own, what all you use, what all you don't use. And that's a very powerful thing that drives Bumblebee. So how Bumblebee's product works is basically we have a software stack that remembers and retrieves things, like that inventories your whole, all the stuff that's in Bumblebee. And only when you need it, you can contextually bring it down and group them together. It becomes a home organizer, kind of like Marie Kondo in the ceiling. That's kind of like managing all your stuff.
Bumblebee Space's CEO and co-founder, we thank you for your time, Sangashin Murthy. Just to let you know that Bloomberg Beta, the venture capital arm of Bloomberg LP, is an investor in Bumblebee Spaces. Now that does it for this edition of Bloomberg Technology. Reminder that we are live streaming on Twitter. Check us out at Technology, and be sure to follow the Global Breaking News Network at TikTok on Twitter. From New York, this is Bloomberg.